Good afternoon, everybody. Welcome to the Monday edition of the TraderMerlin show. Congratulations, you Warriors fan or Lakers fans. Just have to put out there, blah blah blah. I don't know what happened. And the Celtics, boy, those 76ers, talk about one of the most colossal breakdowns in the second half. Anyway, I guess I owe Mike a cup of tea from Starbucks. Pick your date and time, and we'll make it happen. So congrats to the Lakers. Better luck next season for my Golden State Warriors. On that note, today's shows, as most, are driven by viewer questions. So I received this one about a week ago, and I'm a believer of market mantras, and these market mantras are there for a reason. The trend is your friend, to the bend at the end, sell in May and go away, the Santa Claus rally, as goes January, so goes the rest of the year. All of these have merit behind them as to why people say them and utilize them. However, I'm certainly a firm believer of everything works until it doesn't. So making sure that you know the rules behind it. And yes, you could sell in May and go away if you choose to. However, that may not be the best course of action. So John sent in this question, which was, can you talk about sell in May and the sell in May belief? Hey, John, I will absolutely do that. And there's the graphic to support it. I've got a frustrated looking trader, staring at a bunch of screens saying sell in May and go away. So I guess the question is, what caused this mantra to come to life? Why is it even there? Well, I don't have the book in front of me. It's in my downstairs studio, but I'm upstairs today where no library or books are. And there's the Stock Trader's Almanac, which is a staple for anybody who's really addicted to the markets like myself. And by the way, I do apologize for the hammering. No one is knocking at my door. They're doing construction outside my window for the next year. And you're going to pick up all kinds of sounds on my microphone. So I apologize for that. Can't do anything about it unless I don't know, move. So Stock Trader's Almanac, which I would encourage everyone to get a copy of it, especially if you have somebody who's a big-time trader and really just enthralled with markets. They have Stock Trader's Almanac and Commodity Trader's Almanac. Now most of it's done online. I prefer the physical book. It's just kind of fun to thumb through it. But they have a lot of just historical data and statistics on market that goes back, 50, 60, 70 years. So Jeffrey Hirsch, who is in charge of it now, he took it over from his father, Yale Hirsch, and it continues on that, I guess, art of collecting data, extrapolating something from it, and then giving us the added benefit of their analysis. So what they noticed was, and I got to do this all off the top of my head, I apologize, from November 1st until April 31st is the best 6 months of the year. So it really shouldn't be. It's funny we have this sell in May and go away mantra. It might as well just be buy in November and dump in April, right? That would sound better. But it splits into two 6-month segments, essentially. And the best performing 6-month segments, statistically proven over time for the past 60 years or so, is from November 1st to April 31st. So buy on November 1st, sell everything in April 31st. That brings you to the sell in May, which is sell May 1st and buy back on October 31st when these markets start to bounce back up for that November run. Now, how true is it? We'll look at the past couple of years to see if it really has worked. You might be surprised at the results, and then I'll give you my feedback on it. And I'm going to ask for a bunch of interaction on your part today as well, because when you look at making the decision of, hey, I'm just going to sell my portfolio and move away from it, you might want to have some justification as to why you're doing that, and then also the rules around it. Like, okay, I'll sell if these three things line up. I'll buy back in if these three things line up, or whatever the case may be. Or as Tom Barr would say, I don't know if Tom is here today, Tom would say, yeah, actually, you said it earlier, sell premium in May, June, July, and go away. Yeah, or just sell premium. There's always strategies for it, but I guess the main thing is, why sell in May and go away? So what I thought I would do, let me go. I'm going to do this on the SPY because I thought that would be a little bit easier. So 1 sec as I bring this up. Okay, so here is the S&P 500. And what you're looking at, a couple different red lines here. And again, I'm using the S&P because that has always been my assumption that is the market, right? So the S&P 500 is the market. Margaret, that's a great question. Margaret says, only U.S. stock market. I have never looked at this type of analysis on international markets, only U.S. And again, I'm using most of the data from Stock Trader's Almanac. So I can't say it doesn't work on international markets. I guess before we dive into why there's that 6-month split, why would you think that during the month from May to October that markets would underperform? And it does not mean that they crash. It's not saying that the markets implode and they go down 30%. It absolutely doesn't say that. It's either fairly unchanged. It's just almost flat and really doesn't do anything. So I guess the belief is it's a waste of your time. But type in the chat why you think the market would go flat that time of year, right? Why from May 1st until October 31st do we see lackluster performance usually, not always, but usually on those markets? And while I'm waiting for you guys to type some stuff in, my contention would be it's summertime. It's spring into summer. And here in the US, that's when a lot of people take their vacations. And I think that you do get a lot of professional traders, people who work for big banks and brokerages. That's where they're taking their summer vacations and going away. So you might lose some of that liquidity in the marketplace and things just become slightly less active. Now, I'm sure that's not the only reason, but I think that does play a little bit of a part as to why we see lackluster performance in those summer months. Traders partying in the Hamptons, I think that would go right to my vacation part, right? Yeah. Vacation this summer, both CEOs, politicians, rich Wall Street traders, exactly. They're just taking time off, and they should, right? We all should be taking as much time off as you can. Tom says market manipulators go on 6-month yacht rides. I don't know if it's 6 months. I think, some people might be taking a couple weeks here, a couple weeks there, but I think that the cumulative utilization of vacation is going to be between May 1st and October 31st, right? You get the late bloomers that want to do October and go over to Ibiza and party in Spain, and then you get the other ones that just travel around. But yeah, big money movers are not there. Exactly, Skilled. And that's it. Is that the big bucks calm down a little bit. And I'm sure there's other reasons, but I think from my experience and just having worked with institutional traders, that's a part of it, is the big volume disappears, the heavy hitters go away, and volume starts to drift a little bit lower. So we can actually add in volume here. And you're not seeing too much of a big distinction here. There's no real outlier that shows between May and October that volume declined significantly. I'm looking at the SPY here, and you can see the volume at the bottom of the chart. Doesn't really give us any overly confirmation type of basis that volume is the main factor. But I think it is that the big guys are leaving. So let me just real quickly look at the dates here. So what I've done in red. You guys see I've got 2 vertical red lines. Don't worry about the blue one just yet. That'll come in later. I got 2 vertical red lines here, and that is May 1st is your left line, and then on the right-hand side you have October 31st. So that's the window of time where historically the market's probably going to do something like this. Let's go to the close there, and it'll just be, I'll say, just slightly down. No big deal. It's going to, or slightly down, slightly up, but it's not going to do much. That's the general belief. So if you believe that it's going to underperform, you could short the market. But honestly, they generally don't fall that much. Let's go back historically and let's just draw a yellow box around last year just to see what that might look like. So let me get a yellow box on here. There it is. Oh, where's my yellow box? There it is, rectangle. And let's go from October, we'll do last year's cycle. Last year's 6 months. So let's go to October 31st. Which is right there. Sorry, I'm doing this live. And then I will just drag this over. I need to zoom out a little bit more to get to May 1st. But here's your May 1st. So if we look at that yellow box, what's contained in that yellow box represents the data set that we're talking about. And that's just going from May 1st open to the 31st of October's close. Now, if I were to draw lines on that to see what the performance was, May 31st or May 1st was right there, and we go to where we closed at, we actually had a fairly decent decline in that cycle of about 6.22%. Okay, so at least last year in 2022, it actually worked, and you had a 6.2% slide. I guess now the question would be, what was the 6 month after that? And we could make the argument that it actually performed rather well, because there's November 1st through, we'll go to May 1st, and that was a 7.46% slide. So if you got out, you save yourself 6-point-something% worth of damage on that down move for 2022. Well, now that we've got those boxes there, it makes it a little bit easier for me to see where the next one was, and I'll put the next yellow box back on 2021, right? Let's just see what that one might look like. And again, I'm only doing this so we can visually see if this mantra, this data set that everyone talks about, actually works. Does it come to fruition? So here is the next one. right? The yellow boxes are going to be the sell in May philosophy. Well, notice in 2021, if you sold in May and went away, you'd be kicking yourself because you had a huge rally up in the equity markets for that window of time, roughly 18% move. And then the second part, which is usually the better performing, was actually down about 10%. So again, it just goes to show that everything works until it doesn't. So if people are going to ask me, hey, Merlin, sell in May and go away, I would say no. Don't sell any day and go away. Look at the charts and see what the charts are telling you. And if the charts are saying, hey, you got weakness coming, then you can potentially sell and capitalize on the profits that you have, or maybe even go short, or as Tom would say, sell some premium at levels much lower and collect that premium. So the answer to the question right away for John is sell in May and go away? No. You can't make any blanket statements until you see the charts. Now, statistically, we know, based off the evidence, that it is a weak performing 6-month window. Another interesting thing that they do in the Stock Traders Almanac is they actually look at adding confirming indicators or supporting tools. And one of the tools that they use is called the MACD, Moving Average Convergence Divergence, for those who may not know. And all the MACD does is take the 12-period moving average and the 26-period moving average and looks at the difference between those two. So it takes a relatively short one, the 12, and then the 26, which is, let's say, medium term, and says, are we seeing changes in that window of time between the last 12 days and last 26? That's really all MACD does. So let me go back to the charts here. I'm trying not to mark these ones up too much. I got all kinds of old markings on them, so I'll get rid of those and just keep the pertinent ones. So if I add the MACD on here and it's at the bottom, right, I'll zoom into most recent data. So you can see the red line is where is May 1st. That's where the textbook would say, time to go short. If you look at where the MACD crossed, it actually crossed on April 24th and now is down below the moving average, right? So the MACD is now pointed down. Based off of this, it told you that you should have gone short on April 25th. That's when you should have gotten out of your position. So you had, in this example, a MACD that was above zero. And for those who may not know, when it's above zero, obviously that's very bullish. You want to see it trending up. That means it's going to get more bullish. Whereas what it's showing now is it was bullish, but now all of a sudden it's starting to get a little bit weaker. So if you're using the MACD, you actually would have gone short back here or gotten out of your positions right around 406 on SPY. Whereas if you just did it arbitrarily May 1st, your number would have been 415. So you would have done better if you just did May 1st versus using the MACD. Now again, the MACD, what it's designed to do is say, sentiment is changing, trend is drifting lower. So this is obviously a bearish sentiment, and that may tend to continue. What I would say for everybody here is, if I look at this price chart, and let me remove some of these because it's starting to take a little too much space for me. If I look at the price chart of the SPY right now, I'm not bearish, right? I'm not in any way bearish. I'm starting to feel a little hesitant, and the only reason is that the last 3 weeks to month have really been sideways. You can see this kind of sideways consolidation here. So I think that this one is definitely showing some weakness, although it's still making higher lows. So you've got higher lows since October of last year, higher lows, higher lows, higher lows. You also have higher highs, and right now we're flirting with those highs at 415. So for me, I would not be looking at the sell in May go away if I had a big portfolio and I was more of a market timing individual. What I'd be doing here is I would be doing the yellow box. I draw a yellow box around this range right here and say, okay, if we break down below there, I'll just get out of my positions and lock in some profit. But for now, I have to say it actually looks technically like a bullish situation. And Tom's right. I mean, every year is going to be different. But he says 2021 was not normal. It was pumped with trillions of dollars of money printing, so sell in May was buried. Yeah, right. And let's just do one more. I guess 2020 doesn't count. That's a complete outlier. But let's go to before we had a pandemic. Let's just look at that sell in May and go away for 2019, just to see how it might have looked, right? So let's go to May 1st. I'll just do percentages. I don't need to do the yellow box. There's May 1st. And where's October? 31st is right. So that wouldn't have worked either back then. Right, October, it would have been a nice move up. October 31st would have been roughly a gain of 4.32% for that 6-month window of time, which, pretty darn good. Yeah, look, so we are definitely printing, although the question is that printing press going to stop? So, John, I love the question, which is, can you talk about the sell in May and go away belief? I always listen to it. I always look at it, but I'm definitely not going to make the trade just because it says sell in May and go away. Now, let's go back to this chart just because, it's one thing to talk about the past and historically what things have done. Here's SPY again. If I'm looking at this chart and going to be making assessments as to whether I want to be a buyer or a seller here, my main bias at this point is going to be the technical price chart, which is telling me it's definitely slowing down a little bit, but I don't think we're done with this move up. It's still starting to show a nice uptrend. I guess what I would do personally, and I will do this as a group exercise, is I'm going to analyze those charts and I'm going to look at things from a technical perspective, right? First and foremost is just technical. And then what I'll do, and I've told you guys this before, is I grab a little 3-ring notebook like this, or binder, piece of paper, whatever. You can use any piece of paper. And I just make 2 columns. I like this one because it actually has a pre-done partition for me in the middle. But on one side, I will put a plus column, and the other side, I'll put a minus column. So I'm just curious, from your perspective, if we look at this chart here, and it looks like it's bullish, it's making higher highs and higher lows, what supporting information can you guys give me? Right, and type it in. We'll have just a group discussion here. Of course, I can't give you guys the microphone. But what things would you say are positive pieces, which would be a catalyst for further upside move in this market? It could be macroeconomics, could be all kinds of different stuff. But what factors do you guys think would support your decision to hold your positions and go long, or maybe even add to positions here? Right, there's certainly going to be things that are coming up in the market from a data perspective that are going to influence this. And there are some big macro pieces that look pretty darn good, that look like the market could continue on up. So what are some of the things you think are positive, bullish for our markets, let's say for the next 6 months to a year? And then we'll flip it and go the other way. You think volume is what? Explain all of our volume. Why do you think volume? Because you're not seeing too much here with regards to volume. Here's SPY. You're actually seeing a drop off of volume here over the past couple weeks. It's gotten much lower. And if you're referencing, volume being lower in this next 6 months, yes, but that just generally adds volatility. That doesn't necessarily mean that it's bullish or bearish. It just, when you have lower liquidity, it means that the fluctuations of price are going to be more dramatic because you generally don't have enough buyers or sellers to slow down a move should it move one way or another. All right, what else we got? I'm going from the top. Okay, Alexis says positive. Agreement on the debt ceiling. Yeah, and we could make that both arguments, right? Alexa, we could say debt ceiling is going to be a positive factor and a negative factor. If we raise the debt ceiling, which we most likely will, I'm still in the 90+% category saying that we will have a agreement on the debt ceiling, then the markets will be like, okay, good, that's averted. One less variable to forget about and move forward to other things. So yeah, an agreement there with debt ceiling. I'm going to just make any notes over here. An agreement on the debt ceiling would be both positive and negative, depending on what the outcome of that decision is. Let's see. Westlook says, yeah, but I'm more short-term, wouldn't hold till October. That's fine. But just got to know that if over the next 6 months, there's generally more historically a bearishness, then maybe as a short-term trader, you start looking more for those short setup trades, right? So even though you might be shorter term, these larger market mantras still have a lot of relevance for you. JBG says it hasn't yet hit the supply zone. So obviously there's multiple supply zones here, right? And we are just smacking our head against it. We've hit in this, at least in this shorter term supply zone that you see on the SPY right here. I know I've got lots of artwork on it. I'll delete all this stuff later, but you have this overhead supply, the peak of this one being on SPY right around 418, and we're currently trading at 413, down slightly in the after hours. But it just feels like consolidation. This is nothing to worry about. The real question is what happens next, right? If we do break down below here, shorting opportunities, if we break it above, then that's good. Where's the next supply zone? You're looking at the last, at least in this, there's a couple ones, but I'll just use the major for now. You're looking at between 426 and 431 is that next stop. And that obviously would be a nice pop in the market. So yeah, we haven't yet hit the upper one. Liz has possible Fed pause and debt ceiling resolution. So if we look at the Fed, let's go real quickly and go to the Fed funds futures just to get an eye on that one, because this one's been shifting quickly. You're seeing certainly a lot more people expecting, wow, we're up to 24% now, that there's actually going to be a 25 basis point increase. So this will certainly be a factor. Now, here's the tough part, Liz, and I think you've seen this and may agree, may not agree. It's tough because you look at the data and you say, all right, inflation is slowly coming down. Unemployment is staying at historic levels, and GDP is not great, but it's not atrocious. So the Fed may be inclined to stop raising rates, right? So let's cut the rate. Let's pause raising rates, which most would view as a bullish thing. Then all of a sudden you get the second group that comes in and goes, well, if you pause now and we're not done with inflation, then you're just extending the length of this problem. So you get these people who are anticipating the move of the Fed or any real economic announcement and trying to break it down to find those details, and they'll take the opposite side of it. So while I agree, positive it would be if the Fed stops raising rates. That means less pressure on the credit markets, which means more available credit, which means market growth. But there's some people now viewing that as a negative thing because inflation's not done yet, right? We're still at 5%, so we got to get to 2%. That's a tricky one, but I generally agree that if the Fed were to slow down their rate increases, then we start to see some market moves to the upside. Let's see, what else do I got? Market trending in market trading in some markets. Market trading in some markets. Well, I think you're talking about trending, which has been pretty decent. If I look at the broad market indexes, hey, Lisa, konnichiwa, arigato. In Kyoto today, huh? Nice. Hey, Lisa, you should try to go to the ramen museum. I want to go to the ramen museum at some point. I've heard all about it. I'm a huge ramen fan. There's a couple great ramen places around here. Apparently, they have a ramen museum where you can get dozens of different types of ramen all in one place. I'm going to walk out of there having gained quite a bit of weight, but you only live once. All right, so let's just real quickly, since I am focusing on the NASDAQ, on the S&P, we could look at other markets as well. And I think this is what your point you're making, Vernon, is you've got that strong trending S&P. You've got a very strong trending NASDAQ. The Dow is the outlier here. It's kind of interesting. The Dow was, at one point, the strongest of the markets. Now it just kind of feels like it's lost its steam, and maybe that's just because more money going back into tech. But the Dow certainly does not look that great. And then you have the Russell 2000, which, I still am of the opinion that it looks like it's getting a little bit weaker and weaker and weaker. But all in all, it's holding. But we do have great trends going in NASDAQ and the S&P. All right, so those are some supporting ones. What else do I have? Continued rotation to big tech. Yeah, Chase, that's the big thing. I think I think that one part that wasn't mentioned here is not only that the rates might not increase anymore, there would be a pause, but also jobs, the unemployment piece. I know this sounds weird, but when I'm thinking market, that doesn't mean the population. When I'm thinking market, it's the tradable securities that we can capitalize on up moves or down moves or even sideways moves. So when you have all these big tech companies laying off thousands of employees, their bottom line should get better with regards to revenue, earnings, and all those factors. They're cutting the fat. So all of a sudden they've leaned down. They've now got a streamlined operation, got rid of millions of dollars worth of payroll. That could also do very well for the markets because now their next earnings numbers could come in better as well. Not to mention that Apple is doing a $90 billion share buyback, which will skew the numbers, will make them look more profitable, and that could bring up the NASDAQ and S&P even more. So you have all kinds of factors there. I think that's the unsung hero here. It sounds bad. Oh, people are losing their jobs and being laid off. Yes, in the grand scheme of things, that is going to impact the economy, but for the short term, the companies like Apple will report better than expected earnings because they've trimmed so much fat. No more Sleepy Joe. Look, I hate getting into politics, but I do have to say, out of 360 million people, many of which I met who are amazing, good people who love to do good for the country, the two we have to choose from are Donald Trump and Joe Biden. So that to me shows there's something fundamentally wrong with our system if those are the only two choices we have are those. And I'm not going to I have comments to lambaste both of them, but I don't want to polarize you guys and make you hate me because I say something bad about the president that you chose. But there's far better people who could lead this country, yet we only get to choose from those two. It's embarrassing. Anyway, all right, so that's your good stuff. Other things I think would be good on this, obviously, it's going to be the earnings. You're talking about streamlining business operations. If the Fed pauses, that could be a really good factor as well. Any sort of pop up in the GDP numbers could be good. Also, if those rates come down, the bond market, that's another big factor because the bond market is the cost of capital. If that starts to drop a little bit, that's great. And you notice that it has been, let me bring up the 10-year here. We'll bring up the 10 and the 30. Just so we can look at both those. Here's your yield for the 10-year, and notice that the 10-year has slowed down, right? It was up at 4.35% back in October of last year, and now we are sitting at 3.5. So we've lost almost 1% on the yield there, which is great, right? Let those things slow down a little bit, and the cost of capital, real estate, this could help a lot of factors if this keeps drifting lower and lower. So this is another one. Follow that 10-year bond and interest rates. All right, what about bad stuff? What things do you look at and you go, man, this could really be, a piece that kicks the market in the teeth? And forget about debt ceiling because we've already determined that straddles the fence, right? If they don't raise the debt ceiling, then we have some serious problems ahead of us. But what other things do you think could come out there and be very negative for these markets? And the challenge here is there's some stuff that's scheduled, these earnings announcements, these GDP announcements, economic data releases, that's all fairly predictable. The outliers here would be the black swan events, things you just don't know that are going to be coming. And or at least they come out of nowhere like the pandemic did in 2020. So what are your thoughts on things that could bring us lower? I've mentioned before that I think that the commercial real estate market for me is this dark horse that's just kind of sitting out there waiting to just come and attack the markets. I think that's going to be a very bad piece. JB says war. Now, JB, if you go back historically and look, it on a personal level, war is awful, right? Nobody wants it. Get rid of war. Let people live their lives because the only thing we know for sure is we've got one life to live on this planet, so everyone should have that right. That won't necessarily hurt the markets. Historically, I've seen that conflict and war is actually good for the markets because it creates jobs. So while there's usually an initial shock of a war, and I guess it depends on the magnitude of the war, but I remember 9/11, like when 9/11 happened, those markets tanked abruptly, and then all of a sudden they ripped up. They had a huge run up. They subsequently fell to lower lows because of just overall economic crisis at the time, but generally it's initial knee-jerk reaction down and then markets rip up from there because of job creation. It's a massive economic stimulus. Glenn says more bank fails. Yeah, and that right now is a bit of a wild card, right? We don't know who's next or if there's going to be some other ones. I didn't look at XLF today. So here's XLF for today, up 0.82%. What I've done is I've actually created a list down here at the bottom of my watch list, which is massive, and you have some pretty big game. Like wow, Zion Bank Shares. It was one I was maybe thinking of buying as a risk play. Schwab up 4% as well today. So you have some pretty good winners there. Do you have any bad losers? No, a few regional banks. I don't know who this Arch Capital Group. I don't know these companies out here. Market Access Holdings. MSCI, Progressive, doing poor today, but all in all, financials looking rather decent today. But you're right. I think that's another big factor would be that banks start to fail, or more banks start to fail and get down there. Let's see. Continue to lower the bar on earnings estimates, so they all beat, and how many times they say AI's earnings call is also positive. So that's more on the positive side, right? And I agree with you. If you have the lowering of earnings expectations, it's like the high jump going the opposite direction. You watch the Olympics, you watch the pole vault, and those guys every time they're creeping it up and up and up. In the financial world, they lower that bar. It's like, oh, we couldn't make 12 feet. Let's go back down to 6 and see if we get it. And then they jump over 6 feet and they clear it by a mile. Like, oh, we had blowout earnings. Like, yeah, but you cut your earnings estimate in half. It's this sleight of hand, the magic of the financial markets, where it's like, oh, we beat our earnings, but we're just not going to let you know that we lowered our forecast by 50%. So, yes, I think that's definitely what a lot of these banks and companies are going to be doing is lowering their forecasts on earnings. Therefore, it's easier to jump over that hurdle and obstacle. All right. Yes, I did mention my bet, Oliver. I only bet one. I was hoping others would have done it. But yeah, Mike LaRusso, he bet me he doesn't drink coffee or alcohol, so we're going to go have a tea over at Starbucks one of these days. But yes, I'm not going to renege on my bets. I'm good. Liz says escalation of Russia, Ukraine, or China invading Taiwan. Yeah, that's a black swan that I don't think anybody wants to have happen, right? Nobody wants to see that happen, but that could create a conflict, a war conflict, but more importantly, in that type of conflict, it would disrupt global trade on a colossal scale, especially if China was involved and on the opposite side of us. That would be very bad. So yeah, that's probably the biggest wild card other than the debt ceiling. Once that's gone, then I think we could get that conflict in Russia with China, Ukraine, that type of conflict could be much worse. And, the other piece here, which is not going to be the next 6 months, certainly not the next 6 months, but we've had that conversation on the US dollar losing a little bit of its reserve currency status. And I think that's a developing news story, right? I think it's going to continue to grow, and you'll hear more talk about the BRICS countries kind of getting together, and maybe more transactions are going to be done in non-dollar dollar denominated assets, and therefore making a little bit more tension out there in the global community. But that's something that I think is going to be a multi-year play. So yeah, I think we've got most of the good stuff out there with regards to what's moving markets and the pain points. Bottom line is, this is where you're going to be making your determination, right? So if you add up all those pluses and minuses in your columns and you say, well, I got way more pluses, okay, fine. But the price chart here is telling us to hold and stay positive, right? To stay somewhat bullish, not aggressively bullish, but to stay somewhat bullish because that's the way the trend has been going. Let me see real quick. Some positive for tech can also be a negative when and if they decide to sell. Worried about should they shoot the general for last thing? Yeah. But I don't worry about that yet, right? I just go with whatever that trend is. The trend makes it easy. You can remove your emotions, And again, I have a whole list of positive and negative things that could impact the market. And while I always want to keep that in my head and kind of just be aware of what's happening, I'm not trading a conflict. I'm not trading a debt ceiling announcement. I'm trading the price of the securities that are impacted by those announcements. So that's really a big fact. John Todd says international conflict and recession. One other piece here that I want to mention. In recession, there's an argument, are we already in a recession, right? Many believe we are in a recession. I would say, judging by the stability of price over the past few months since October, that's not very recessionary, at least from a market price behavior. We had our 2 quarters of consecutive negative GDP, but now they're back to positive GDP. Now I got Chat GPT in my mind. Positive GDP. So the recession argument is almost off the table for most people. A lot of people still believe that we're there. I kind of don't think we're really in a recession environment. I mean, things seem to be doing okay. The dark horse here, I've used dark horse twice in the show. I can't do that. I guess the one that I'm waiting to see if it does happen, and this has been one we've talked about for a year now, especially with Bill Addis, is not recession, but getting into a point where you get stagflation, right? Where you have this situation that's very difficult to get out of, where you have rising unemployment, you've got high inflation, and you've got slowing growth. Well, we've had slowing growth, we've had rising inflation, but we haven't had rising unemployment. So we haven't had that yet. If we do see a surge in unemployment, then all of a sudden it could put the economy in a situation of stagflation, which is incredibly difficult to get out of, and that could put more pressure to the downside. But again, am I gonna short these markets because I think that's what's gonna happen? No. I'll short these markets or get out of positions if and when it starts making new lows or my strategy is violated and I now need to look and go the opposite direction, right? Otherwise, you stay the course. Zed says, do you think that large caps like Apple will be doubled in the future or slow down? I think that they're going to slow down. You look at the size of Apple, you got a $2 trillion market cap. I think that it's the nature of business cycles is you have leaders for a while and then something happens, some change in technology, some innovation comes along and then it replaces that, and not to say that this is the company that could do it, but what about SpaceX? Like, what would happen from a pure business perspective if Elon does set up a base on Mars? What are the rules international? I mean, who gets to own that? If he's the first one to get there, does Elon Musk now own Mars, right? There's going to be some laws and say, oh no, that's going to be the property of this government or this government. Well, does he get the rights to all the natural resources and minerals he gets off that planet? I mean, God knows maybe goes there and all of a sudden he finds just mountains of gold or titanium or some precious metal. He starts bringing all that stuff back and selling it here, making trillions of dollars. I mean, and of course, that's an exaggerated example, but it's just a what-if scenario that we don't know. And that could supplant somebody like Apple very, very quickly. Maybe there's a new technology. Right? I mentioned this the other day. Maybe NVIDIA comes out with a little piece of paper or a temporary tattoo, and that's your communication device. No longer need hardware from Apple. Well, that's going to hurt the Chinese economy. That's going to hurt Apple. So I think there's always something else that will come along and replace big companies. So I don't see Apple getting to a $4 trillion market cap. I mean, the world's growing. Apple's selling more and more products and services. But at a certain point, you're going to reach a plateau with who you can sell your goods and services to. So yeah, I don't see them getting to a $4 trillion. I do think you'll see more companies come up and compete and take away bits of their market share. But who am I? What do I know? Okay, good. So I think we pretty much got it. If selling starts with a bad foundation underneath the surface, if the selling starts with a bad foundation underneath the surface, yeah, I'm looking at my neighbor's house over here. Like, well, I think they did an okay job on the foundation. All right. As far as markets go, let me run through our top 7 here just so I can get to what happened out there today. We have a little bit of a rally going on in crypto, which is welcome for me. The downside here, well, I'd say down. It wasn't negative, but the weakest performer we had on the day was that Dow. And it's really hard for me to look at the Dow and make it any sort of positive or even negative call on the Dow. It just looks like it's listing. It's not really doing anything, just sitting there kind of traversing sideways, no real clear trends. Yes, you could argue that the past month has been down, but it doesn't really look that great. So that was your worst performer. It's up 43 points today. It's funny, for something that's 33,400 points, was only up 43 today. 0.13%. Same for gold. Here's your GC. Gold at least has some technical patterns to work with, right? We still are looking at that line in the sand of 1990 on gold futures. It was up 0.14%. S&P was slightly up 0.29%. Similar picture with regards to listing sideways for the past month, but at least it has a better trend developed and defined than we saw with the Dow. NASDAQ, the best trend of the major indexes, up 0.54% today. But again, I still think that this overhead supply is going to be your next stopping point. That's between 13,630 and 13,760 on the NASDAQ 100 futures. Podium time, Russell 2000, 1.2% positive gain today. I'm still overall bearish on it. Just look at the price chart, right? It has not been able to make new highs, but just showing weaker and weaker. So that's the basis for my negative call on the Russell here. We'll see if it challenges these lows over the next couple of weeks. Crude oil was your number 2 silver medalist, 1.53% gain for the crude oil markets today per barrel. And let me get some of these lines off of here. I'm not sure why those ones are there, but I'll leave that yellow box up there because that might be the next stopping point if it breaks this most recent high it achieved on May 9th. So 1.53%, $71.11 per barrel for crude oil. And last but definitely not least, you had Bitcoin, which gave really a short break down below that 2666 mark, which I kind of said is a line in the sand. It actually closed below it, and then the next day ripped back up. And actually, we can look at this on a spot chart. It's a better look at this on a spot chart. So let me real quickly bring that one up here. So here's BTC on a spot chart, and you can see there's your 26,666, and we had a long tail below that on the spot chart, but did not close below it, and now all of a sudden starting to show a nice little move up. Now, the interesting part is if you are a supply and demand person, you notice we have a supply zone right around 27,650, which was the high for today. So kind of interesting to see, is this just a impulse or a corrective phase from a bigger impulse down? Well, time will tell how we pan out from that one. But all in all, not looking great on Bitcoin. Right, we got that downtrend, lower highs, lower lows, at least starting from April 14th. So it's not the biggest downtrend, but it's still intact on that short term. I know many of you are looking at longer term, which certainly looks a lot better. Nice impulse and corrective phases. We'll see how this all pans out. Anyway, that was your number 1 performer out there. Last part that we got to get to before I wrap up the show for today is your dollar index. There's your Dixie, and this is part of the reason you had a nice little reprieve today in these markets, some nice gains, is we had a slight down day today for the dollar index, only down 0.25%, and that comes on the heels of a really nice 2-day rally. I guess I'll get rid of this little yellow box here for now. A really nice 2-day rally for the dollar index, but gave back some of it today as we came into the high price that we achieved back on April 10th of 102.80. Okay. If you guys have any other questions, I'm going to go to the economic calendar for tomorrow, and then we're going to wrap up the show. I'm going to do a 40-something minute show today. Woo, woo, make it short. Here is your economic calendar for mañana. Now, there's really nothing on the earnings front. Actually, there's Home Depot reports tomorrow. That will be one. But there's a lot going on with your economic calendar. And I know a lot of you can't read this on the screen, so I will read out the major stuff. If you're trading the euro, I know we've got some currency traders in here, and I apologize. I really don't do too much with currencies on this show. I should probably do more analysis. I know Skilled Stocksman would love that, right, Skilled? So let me just run through for the euro, which has been on a pretty aggressive sell-off for about the past week and a half. You do have industrial production numbers, which came out today. I'm reading the ones that came out today, and then we'll go into mañana. And the reason I'm starting with today is it's really about the U.S. So you had industrial production with a much steeper slide than expected for the European markets. So that was fairly bearish. Came out at negative 0.41. But really for the U.S., this is the interesting one. Empire State Manufacturing Index. So a previous number was 10.8. Anything above zero means that there's optimism with regards to manufacturing. Anything below that, they're expecting contraction. And the expectations were we're going to come out at negative 3.7. They actually came out at negative 31.8, which is extreme pessimism. And that means people are really negative on manufacturing in the Empire State area. So that's really not good news that came out today. And I was kind of surprised to see the market shrug that one off. I think they're more focused on the dollar. But either way, that was your big piece for today, which, we have more of these indexes coming out. You have the Empire State, you have the Philly, Chicago, so there'll be a few, Richmond, there's a few more other areas that will be coming out with their manufacturing numbers, and we'll see how those pan out. So here's what's happening for tomorrow, the 16th. Yes, this is even smaller. For your European traders, you have a lot. You have the German ZEW Economic Sentiment Report. You have GDP numbers coming out for the European Union, as well as the ECOFIN meetings, which are always interesting. You have President Lagarde will be speaking at 7 a.m. Pacific time. So that will be 30 minutes into the trading session tomorrow. Lagarde will speak, and of course, she can have a pretty big impact on our markets. Now, if you're in the Canadian markets, you have CPI numbers coming out tomorrow, which should be impactful. And Canada has a variety of them. That's going to be at 5:30 a.m. Pacific time, so 1 hour before the markets open. But they have the CPI, the median, the trim, the common, the core. They have a bunch of different categories of CPI. All of that is expected to come out tomorrow at 5:30 in the morning Pacific time. And then really for the U.S., we've got a couple big announcements as well. You see retail sales coming out at 5:30. Now, at 5:30 Pacific time, that's expected to actually go positive, which is good. We've had two consecutive months of negative for retail sales, and they're expecting that to now be positive 0.8%. You have capacity utilization rate, industrial production for the U.S. You have business inventories, NAHB housing market index, which really kicks off a couple of really important housing data points. So the NAHB is the National Association of Home Builders, and that's one of those numbers that you want to keep an eye on to see, is there optimism or pessimism on the part of home builders? If home builders are pessimistic, that's a good sign that the economy going forward is in trouble, because they're connected. They've got connections all over the place and know where things most likely are headed, way more than I do, I believe. And I think when you look at the NAHB, if all of a sudden home builders get very pessimistic on it and are not going to start building new homes, that's a sign they don't believe they're going to be able to sell new homes, and therefore that could be a big negative factor for the market. So keep an eye on that one for tomorrow. Is the NAHB Housing Market Index. That's at 7 a.m. So again, 30 minutes into the business or trading day, also with business inventories, and that is most of the economic announcements. So Tom says, the Empire State Manufacturing always seems funny to me. Most manufacturing is in the Rust Belt and the SEC football area where the foreign manufacturers are. I don't know where all the manufacturing is per se, so I can't trust nor verify that one. I know that there's lots of manufacturing that goes on all over the U.S. So as more of these announcements come out, it will be interesting to see overall is the sentiment towards manufacturing. What I didn't like about this one was how big the miss was. Right? It was expected to go from a positive number to a negative number, but just slightly. And all of a sudden, it came out at a much worse number than expected. Hey, Brian, thank you very much. I appreciate that. Oh, yes, I missed you at the Hollywood Bowl. Well, next time we'll have to get back together. You're probably lucky you missed me because I got COVID at the Hollywood Bowl. I love fish shows. Second time, I got COVID at the Halloween show, and then I got it at the Hollywood Bowl. Next time, I'm going to go in a full-on bubble suit, too. But no worries. Next time, we'll catch up and have a beer up there to the next show. What other shows are going on? Anyway, thank you very much, Brian. I appreciate that. So that's kind of it for me, everybody. I did the economic calendars. There's really earnings-wise, you just have Home Depot for tomorrow. If you have a specific topic that you want me to cover, always happy to oblige. So let me know what it is you guys want to discuss. You can email me at the number or name on your screen, which is TraderMerlin@gmail.com, or go to any of the YouTube videos there and let me know what you think. But bottom line, as far as sell and may and go away says, I don't see it, not this time. Things may change, but the MACD just crossed below that signal line in April, not in May. So anyway. Oh, yeah. Well, you know what? I did this the other day. So it's great. Thanks, Questlog. Rise, I'm trying to wrap up a show. You're going to bring me, you just pull me back in. Now, lumber's been brutal. Lumber's been absolutely brutal. We talked about this with Scott McCormick the other day. You know, there's a few commodities out there that have just been absolutely slaughtered. You look at lumber has been brutal. You have cotton, which actually has gone flat. But what was it? Sugar was one that's really just gone absolutely crazy. Check out corn's down. Oh, I don't have my sugar on here. But yeah, lumber has been a big one. And that's certainly going to help home builders, right? When you look at the cost of lumber. You know, we peaked out here in May. Oops, you can't see the chart. Why am I not seeing my that's interesting. Weird. All right. Well, that's perfect. I think I deleted something. So anyway, you're not going to see the chart over here. I don't know why that happened. It looks like something got deleted, and now all of a sudden I can't show you my charts. Very strange. Okay. Well, that worked out perfectly because I thought I had you on a chart, and apparently, so something got deleted on my watch list. There you go. Anyway, lumber, going back to that high that we had here in March 7th of 2022, your lumber prices were looking at about a high of $13.57. Now it's at $3.44. That's 1,000 points lower. That is unbelievable, and I'm sure that's going to help home builders as well. Anyway, let me wrap up and figure out what happened with my screens over here. It's all showing all weird. Okay, well, that's going to do it for me, everybody. Hope you enjoyed today's show. Hope you learned something. You can email me at TraderMerlin@gmail.com for any topics for the remainder of the week. I don't have any other guests here, at least not for this week, that are going to come on the program, so I'll have plenty of time for topics. So thank you guys so much. Enjoy the remainder of your day. I will see you tomorrow. Take care.